All right. Thanks for joining, everyone. Sorry that we're getting started a little bit late. Um, and we had some technical difficulties, but we're here now. And I'm very excited to be joined by Alex Birch from Veritas Equity Partners. Let me share my screen really quickly so that we can show the obligatory disclosure. All right. And I see it there. Perfect. Um, so, this discussion today is going to be for educational purposes only. Gamma Plan doesn't provide any investment advice or tax advice. We always encourage you to go do your own due diligence and seek out the counsel from the correct professionals, advisors, CPAs, tax attorneys before making any investment decisions. Um, Another housekeeping topic is that if you have any questions while Alex and I are talking, just use the Q&A feature. We'll have the chat feature disabled during this, but use the Q&A feature. I'll be looking at it, and so we can answer those questions live as we go along. Alex and I are just going to be having a conversation today, so the more the merrier in terms of dialogue. So please don't be shy. Jump in and ask some questions, please. And then the last item is that if anything doesn't get covered today that you want to learn more about, or you want to learn more about self-direction or Washington State or whatever we discuss, please reach out at this email and phone number, and we'll also share Alex's contact information toward the end. So I will stop sharing. Perfect. All right, Alex, how are you today?
I'm good, man. How are you?
I am very, very well. I work remotely from California in Northern California, so it's a foggy day, but the fog has lifted and the sun is shining through.
I was gonna say I was just in San Francisco for a minute, and it feels like that's a consistent, trend down there is fog in the morning and then the sun pops through. So happened
Yeah,
every single day we were there.
absolutely.
But yeah,
So I think the first place to start is just always like a good introductory and some background about, who you are and what you do. It really like talk to me about life before Veritas and how
yeah.
you shifted into that. So start from there, please.
Yeah, for sure. So thanks for having me. And I always love having these conversations and we'll see where they go. And that's kind of my favorite style is just to have a conversation and see what happens, right? But conceptually, Veritas Equity Partners is my group. We're a real estate investment firm. We're located in Washington State, specifically Kirkland, Washington, for people that are familiar with like Seattle, Bellevue, Kirkland region. And we buy multifamily apartment complexes. So, we're focused on workforce housing, which the way we define that is, workers that make between 60 and $80,000 a year are our typical tenants. And we're focused in regions where housing is basically unaffordable unless you make 250 grand a year. So, those are the deals that we're buying. As a history, I've been doing this since 2010. So, I'm on, I guess, almost my 16th year now, which feels crazy to say. It feels like it's gone by super fast, but I started with my own money, just investing in an 8-unit apartment complex in the city of Seattle. I self-managed, and then over the next decade, I had 1031 and refinanced, and done all of those good things to grow that portfolio to worth about 20-25 million dollars of street value while I was working in tech.
Okay.
So,
All right.
during this whole time, I was also your typical Seattle techie guy, working in a various number of startups in my 20s. In my last tech role, I led a region in the sales org for AWS at Amazon.
Okay.
So, that's the background.
And what made this shift go from Seattle tech bro, sorry,
Yeah, yeah.
into real estate
Yeah.
entrepreneur?
I started in real estate just conceptually for me, it was a way to kind of contain my retirement. Like it really, I didn't intend for it to turn into like a full-time career thing in the very beginning. But about 5 years in, I realized very quickly, like, oh, this could be a real thing. It's in terms of like a business, there's not that many people doing this, and I kind of figured it out. So the plan became very clear, in my mid to late 20s that the goal was always to transition to full-time real estate investor. Just needed to get enough scale to get there, right, for it to make sense. And quite frankly, I needed more reps as far as like experience and deals to kind of feel comfortable in the model. So I was always both, like I was 22 years old when I got into my first deal. That's about the same time I got out of college and started working in tech as well. So, I was living that double life for a long time, but it slowly became not reasonable to do both, once the portfolio got to a certain size. So, that's when we started putting together the idea for Veritas, which is our group now.
I'm assuming that at 22 years old, your first, and I could be wrong about this, but your first real estate deal was not workforce housing related necessarily. So talk to me a little bit about if that's the case, like how you sort of transitioned into that specific like thesis.
I didn't have a thesis. I
Yeah.
knew I knew the concept was that I wanted apartment buildings. Like that was just from since I was young, I was always very curious about money and wealth and how to create it. And I had triangulated in high school and college, like, oh, the people and families that had the type of wealth that I was interested in accumulating typically owned commercial real estate on some level, and a lot of them just happen to be apartment operators. So that's where the idea came from. My first deal actually was a workforce housing deal. It just was sort of accidental because it was a deal that made sense to me. It was 2010, so everybody, at least in Seattle, was saying, "Hey, real estate's dead. This is probably not going to recover. Like, I don't know what you're doing." And those are the funny conversations to have now because people are like, "Oh, you're so lucky that you started, you know, at the bottom of the market, basically." But like at the time, no one else was really doing it, and it didn't feel like, a no-brainer on some level. I just was kind of studying trends, and it made sense to do. But no, it was in a little 8 unit workforce housing deal, 70s vintage, like kind of like exactly what we would buy nowadays, just a little smaller than what we would target now.
So workforce housing can, I mean, there's a pretty, I think people have an idea of what it means, but
Yeah,
geographically, it can take the form of different things. Certainly
yeah,
in Washington, in terms of like size and who the employers are that are attracting that workforce. So, can
yeah,
you just kind of walk through? I mean, really give us like a feel for your due diligence and what you're doing in terms of sourcing deals and
yeah.
underwriting, et cetera.
Yeah, so I think that the same conversation applies to the concept of value add. People always say value add deal, and then, workforce housing could mean a lot of different things. The way we define workforce housing is the tenants that we're renting to are part of more of like the blue collar kind of support, people that like make the region work. So Washington State, particularly Western Washington, Seattle area have so many companies headquartered here. And like I think a lot of people don't even realize like we have Microsoft, we have Amazon, we have Starbucks, we have T-Mobile, we have Boeing. I mean there's the list is crazy as far as like the amount of these like highly successful companies that have their main HQ here. And then every other big tech company has major satellite offices here because they're all stealing each other's software engineers, right? So like that's the whole concept. I mean, like that's why Bezos came to Seattle to start Amazon was to poach Microsoft workers. Like that's why it is what it is. In turn, what that does is create unaffordable housing situations for people, right? So why we love investing in Washington and why we will never not invest in Washington is the exact combination of that supply thing that I just mentioned. The houses are unaffordable. There's no land left to build. Construction is wildly expensive. And there's just like no option for people that don't make. I think the number in Western Washington is at least 250 grand as a family, and it's just an unreachable amount of money. I mean, when you look across the statistics of the entire state, we kind of have like there's a mountain range in the middle of the state that breaks
Sure.
Eastern and Western Washington up. We have several hundred units in Eastern Washington. We have several hundred units in Western Washington. Like we run them both. So, we like both markets. Um, but like a current deal that we're buying, the entry level home pricing for the city that we're buying the deal in is 950 grand. Like that's like a starter house,
Ugh.
like the 60s, 70s split level, 2,000 square feet, like probably still needs a lot of love, like $900,000, like that's just what it costs to buy there. So, we like to buy deals that work, on a pro forma level at hitting median rents. So, that's what I call workforce. And in our market, that's 1,800 to 2,000 bucks a month. Like that's typically what we're shooting for.
When you're so in the workforce housing properties that you are buying, like what are the value add opportunities that you seek out to kind of immediately
Yeah.
do within the first, I don't know, call it 9 months to start, raising rents and
Yeah.
improving the property?
Yeah, so, our thesis is really defined in terms of what deals we buy, why we buy them, the sizes of them, what I need to see in underwriting, all of these types of things, right? But on a high level, what I want to see is rents at least 15% below market for today's number, not like a future forecasted number. And we'll use some data aggregation tools to get that information. But we're talking 50th percentile rents. Like that's our pro forma on these deals. And I want to see them less than that. The size of deals we buy also is really intentional. So, the smaller size deals would probably be about $4 million, which typically translates to 15 or 20 units, depending on, the region of where it is, up to about 60 units. That's about as big as we'll go. And
Okay,
even if somebody came to me with $1 billion and said, buy as many apartment deals as you can in the next 2 years, like my goal would be to stay in that size range.
sure.
Um, the reason for that is there's just so many more levers you can pull to make the deals work. So, we're not buying from institutional operators. We're not buying from professional operators. We're buying from families that have owned these things for a long time. We're buying from people that thought it might be a passive income opportunity, but learned like there's no such thing as passive income, and so then they
Yeah.
want out of the game. Like, so the deals that we're buying, they need some level of cosmetic rehab. They need better operations. Their expenses are typically super inflated because they just don't have the mechanism to run the buildings correctly. So when we come in, first 9 months, first 12 months, really the focus is on operationalizing the asset as far as expenses. We really want to make sure we shave as many expenses as we possibly can. Typically, we can find around 15% a year, like worth of OPEX ratios in the first year, just purely based on managing it our way instead of the way that it was. And then we start our systematic lease increase process, from there. So it's the combination of those two things that I think in any market cycle, but particularly down market cycles, it's repeatable. Like it's as long as we're buying correctly, there's no secret sauce that needs to happen for these deals to work out.
And I know, getting ready for this call, you mentioned Juniper Apartments. So that's a deal you've closed, correct?
Yeah, we've owned it about a year.
Okay,
Yeah.
I think that's kind of a great place to like maybe, talking about what you just discussed about the operational improvement, the financial operation optimization improvements and things like that. Walk through that as that deal,
Mhm.
and kind of talk about the actual things that happened with that with the Juniper apartment site.
Yeah, yeah, for sure. So, I'm just going to kind of go off the cuff here, but we also just did Q4 reporting, so some of the numbers are fresh in my head, so that's good. But
Perfect.
at the end of the day, this is a deal in Eastern Washington. So we talked about that, like Eastern Western Washington. It's a 32 unit that we bought, yeah, about a year ago, and it wasn't like, it was in great shape. The deal's in good shape. We thought that there was room to move the rents. We thought that there was room to operationalize the deal. So we bought it, right? And we started doing this. The immediate thing that we noticed within the first 3 to 4 months was that we had already increased the net operating income of the building by close to 20% just by shaving expenses. Like it was literally like our
Wow.
management model was half the price. So a lot of times what you find in these deals that are, sub 75 units, I would say, like that's kind of the threshold in our market, at least for when it justifies having like an on-site manager. Um, People that sometimes buy these deals that are 20, 30, 40 units, they will still put an on-site manager on there and it just chews up so much in like payroll expense and insurance and all of these things, right? So we don't have any on-site manager. So that was a huge savings. And that helped, I mean, that was a way larger gap than I had anticipated when we bought it. So that was like a really awesome surprise.
Yeah.
I think another story that's really cool that I was just looking at is over 2025 for the whole year. So we bought it like November, December, 24. So we had it for a month or two prior to this. But January 2025, the monthly rent collection was 34,000 a month. Like that was the base collection on a 32 unit deal. Uh, December, so last month, 41,000.
Wow. You said you
Yeah,
went from 34 up to 41,000?
yeah.
Wow.
So, just kind of in my head, I think that's like low 20s in terms of like a rent roll increase.
Yeah.
Um, so this is just like a perfect segue into why I think Washington also needs to be considered by like other people that don't know the region. We have statewide rent control, right? It just passed last year. So, and the number is 9.6% or 10% is what you can cap rental increases at. That's the law. We were still able to add 21% to the rent roll in 12 months of ownership of this thing. And so this is what I mean by like I think people overthink this that you just need to understand the laws and operate appropriately. But what happens a lot of the times is people move, and rent
Yep.
control doesn't impact you then, right? So you could take somebody that was paying 1,100 a month and take them to 1,500 because that's the market. Like that's like a 30% bump, like it doesn't have to be 9 or 10. So when you blend move outs with lease increases, that's our goal is to get to like a 9% a year lift in revenue. Like that's what we underwrite to, that's the goal. When we have more move outs, we're capitalized for it and it works out in our benefit because we buy well and the deals are under rents and all of these things, right? But when we're thinking about actual like rent growth, it's very possible to completely destroy the rent control cap just based on that.
Um, and so I know we also this is actually kind of a good segue about the sort of like the regulatory, hurdles that might exist. Is the rent control kind of like the primary regulatory hurdle, or are there other things in Washington that you guys encounter and are solving for?
Yeah, so I remember a conversation I had several years ago with a gentleman that actually runs commercial banking at JP Morgan Chase. Like, I mean, big time, it has seen probably trillions of dollars of commercial loans over his career, right? Like crazy numbers. And a statement that he said to me directly really stuck out. And he said, "Hey, where there's complexity, there's money. Like you just have to figure out how to and understand the rules better than anybody else. Like that was his concept. So rent control has been being tossed around in Washington for 7, 8 years. Like this is not like a new concept. This
Hmm.
this is the first year that we had it, so it actually passed. So it was interesting to see what that did. It changed nothing as far as how we underwrite deals, how we operate deals. Like my business plan has never been more than single digit rental increases on an annual basis for existing leases anyway. Like I've never had that in a business plan for 15 years. Move outs, obviously, you can crank them. So, like that's where the delta gets to. But what it did do, sentiment wise, across the board, is what we've noticed. It brought a lot of buyers to the sidelines or looking at other markets. And, especially when you combine this with COVID and all of the craziness that happened with like Arizona and Texas and the Sun Belt and Florida and like all these other markets, so did the developers. Like they go there, they build a bunch of supply, and all of a sudden it's an inverse problem, right? Like the supply and demand thing is their biggest flaw and it's our biggest advantage. Like that's the difference. Policy wise, states have lots of different rules depending on counties and cities, and it's not just statewide. Like there's only one, as far as I understand, there's only one that's true like statewide rule, and that's the rent cap at 10% a year. Everything else is pretty much county driven, city driven, and then they all have their own little rules. So King County is where the city of Seattle is. They have some pretty tough rules. Like we as a group don't invest in the city of Seattle. Like we don't buy deals in Seattle. We don't, and we typically don't buy deals in King County either, which is like the county that Seattle is in.
Yep.
We buy in the surrounding counties that are, 20 minutes away from there, so they're close. But we just, for now, we're not buying there. It's a little bit trickier. But each county has its own set of rules, notice periods that you have to give if you're going to increase rents, maybe 90 days, maybe 180 days, things like that. But we just build automation into our leasing and asset management structure to where these things are just happening organically in the background for us on trigger points that we establish when we buy buildings.
Well,
So,
with with the rent control topic specifically, it kind of like rent control is not obviously it's not unique to Washington
Right.
State certainly, but developers are not fond of it in general, or it's just another thing. But it seems like just the fact that it was it was being discussed for the past over half decade, and just like kind of paying attention and knowing this is coming
Hmm.
and being ready for it was probably the biggest advantage to dealing with it. I mean, you had
Yeah.
multiple years to uh, adjust your business plan as necessary just to know that it's coming and to be able to persist through that
Yeah.
change.
Yeah, and the other thing too is I think there's just a lot of dramatics like in the world, all the time with everything. It's just there's so much like people get really worked up over stuff that sometimes doesn't really matter. And so when I remember thinking about rent control 5 years ago, I'm like, okay, what if this passes? Like, what does this change for us?
Sure.
Like what?
Yeah.
Nothing. Like it changes nothing. Like we're going to continue operating that we do. Like what's the risk that over time the rent cap lowers? Like that's possible, but typically if you study other markets, it happens in the cities that like are kind of the central, super, super, super liberal. Like that'd be like the city of Seattle, maybe saying the rent cap here now is 5%, something like that. So we don't buy there. Like we're not going to be there. Where we're buying is it's the other side of the political scheme, as far as like landlord laws and advocacy for owners and all of these types of things. But at the end of the day, the core of what I think matters is supply and demand, income for the region, job security for the region, and like overall the health of the economy where you live. And I think that there is too much talk about like nationwide things that happen when we talk about apartment investing and like overall sentiment of multifamily. And it really needs to be like hyper localized, in terms of the markets that they're in. Like I pay attention to other markets. We don't buy in them, but you start looking at other markets, and I had a little cheat sheet over here that was going to tell me some of the data, but rents are down in a lot of these places that were supposed to be the next all-star market for the
Yep.
next 20 years. It's like, how do you forecast rents if they're down 5% in Phoenix or Austin or Florida? Like, how do you do that? Like when you buy an apartment deal, like you need to be able to see like predictable growth or at least predictable neutrality, in the rents. But when they're going down, it's like, how far are they going to go down? Like, did they recover at some point? Like, how do you buy on a current cap rate or current operating statement that isn't going to be accurate next year and it'll be worse? So this is my whole thing with Washington. We've never had down years in rent, like ever, all throughout all of this. Like any corrections that have happened in the last few years, rent still at an absolute minimum increases 3%, like across the board, and that's just the data. So, it's even on stabilized assets, like the way we run it is 9% in the first year blended between, move outs and increases and these types of things. 7% increase in the second year, again, blended between move outs and these things. Then we drip down to 5% and then we level out at 3. And so there's nothing crazy that needs to happen for our deals to get to the net operating income levels that we're forecasting to. But man, if I was an owner or operator in these other markets, like I would certainly not be buying anything right now. I just have no idea what's going on out there.
Yeah, I think obviously, as a if you're a developer, seeing these white hot markets in 2022 can be really, really attractive, but there's obviously some softening that happens. So I
Yeah.
take your point, and to their credit, there are some people who did very, very well in those markets, but yeah, it can be pretty tricky when things are just seeming like you can't build fast enough, and then all of a sudden you have a oversupply issue.
Well, and tenants have options, right? So it's
Yep.
like, what, why would they move? And like in the exact opposite here, I was just talking to a developer the other day here, and he was saying, even with all the tax credits that he could possibly get and all the subsidies that he could possibly get, he cannot build an apartment complex for less than $500,000 a unit, like all in with like permitting and title and land cost and destruction of the thing that exists on the land when you buy it because there's literally no vacant land here, particularly in Western Washington. Like $500,000 a unit, and that building that he builds for 500 grand a door, might rent for like 2,500 a month or 2,600 a month in that particular market. Brand
Hmm.
new, really nice, all good. I buy stuff that's 200,000 a door or less, and we rent for 1,900 or 2 grand a month. Like we're really not that far off, you know?
Wow.
So it's to me, it's like we're like 50, 60% below replacement costs. Like it's just it's just a no-brainer to me to continue sweeping up these, vintage kind of 70s, 80s properties, operate them well, cash flow them well, like make it really simple. The other trend that I've been seeing is like motel and hotel conversions,
Sure. Yeah,
you
yeah.
know, and that's an interesting one. We looked at it pretty deeply a few years ago, but the construction costs are just so outrageous
Yep.
that you end up getting to like 200 or 160 to $200,000 a unit, by the time you're like, okay, we got this hotel for 50 grand a door, 60 grand a door, whatever it is, but you've got to put 50, 75, 100,000 into like each unit in theory when you're talking about window access and easements and parking lot upgrades and like all the things that make it habitable and the zoning stuff and the permitting, and then not to mention the 2 years that it takes to do the job where the money's just sitting there. Like there's all these problems. And then the real issue is what's it worth?
Yeah.
Like we don't know how to comp these things. So it's like a motel conversion comes on the market for 110,000 a unit. Like you thought yours was going to be worth 160,000 a unit, like when you were done with it, like whoa, like that's a big problem because they're small. They're 300 square feet. Like not to mention turnover rates, probably 3 times the amount of vacancy that, standard apartment buildings have because nobody's really trying to live in a 300 square foot thing for, more than 6 or 12 months.
Well, that's what I
Yeah.
was going to say is the what I've seen on specifically on those motel conversion deals is that they are generally the ones I've seen. I shouldn't say generally. The deals that I've seen is that developers are trying to solve for a housing shortage in kind of low income areas, and so the intent is seems good, and
Mhm.
they are trying to solve. It's somewhat altruistic that they are trying to solve a problem and flip these hotels into being more livable units. But like you said, um, they are hotels. They're built for very short term stay, and so the construction cost to even bring them up into a very very basic apartment amenity level is
Yeah.
pretty steep, and knowing that the tenants are going to be really really limited in terms of what their rent will be to pay. Yeah, the math doesn't seem to math all the time.
No, and I mean, it's all like this whole business is about forecasting, like it's like everything about it, like expenses, rents, like it's really simple in theory, but like you need to be able to understand like what's the money going to look like year two, three, four, five, six, and like no one gets it perfect, like that's kind of like there's some art and science to that, but the more data that you can have to support what you're doing, the better, right? And that's the other challenge when you are like trying to comp these things is like because there was also a I don't want to say trend or whatever we want to call it, where a few of these buildings in Seattle went up that were like they call them like micro units, like
Yeah,
from new construction, right? They're like
yeah,
280 square feet. It's essentially a fancy looking motel conversion, but just built from scratch, right? Like,
yep,
and when you're looking at the rents, it's like you can't really use like a 500 square foot studio as a comp for that. You certainly can't use a one bedroom as a comp for that. So like, how do you forecast the rents? Like how do you really know where they're going to be? And then again, going back to the operations of it, the vacancy rates are so high because like nobody is putting roots down in these little tiny units, So instead of like Seattle on average, I think the vacancy is 5%, maybe 5.5%. Like that's the overall whole statewide vacancy rate. Our stabilized assets run sub 4% vacancy just because we're kind of in like a high demand, like, middle market situation. But those micro studios and motel conversions and stuff, I mean, I would venture to guess most of them that I see 15 to 20% vacancy rates just because there's so much turnover,
wow.
which, that kills you.
So on the topic of how do you project for those and just projections in general,
Hmm.
talk to me about how many. I want to talk about exits. So talk to me about how many exits you've had, who you're selling to,
Hmm.
and kind of a step before that. When you're securing financing, what does your leverage look like? and
Hmm.
how are you how did you navigate the rate environment over the past couple of years? So yeah, I'm really interested about yeah the mortgage
Yep.
strategy and then exits and exit cap rates. I'd love to hear more about that.
Cap rates.
Yeah.
Cap rates. I feel like I could talk about cap rates for like an hour, and like this is cap rates almost like you got to know them, but they simultaneously upset me more than anything else too, just because I'm like this term is just like too broadly thrown around, and it's just I don't know. But we'll get to that. But debt strategy for us, exact same thing every single time. We're super conservative. So we don't do anything other than agency loans. So Freddie, Fannie, 7-year fixed is the shortest amount of time that we will get for a commercial loan. Sometimes we'll go to 10. But I will never go less than 7 years in terms of our fixed rates. Typically, what that looks like on a deal that we're closing here in a month from now, it'll be 5.65% will be the interest rate,
Great.
fully amortizing over the amount of time, except the first 4 years, interest only payments,
Hmm.
fixed for 7 years, and we put 30% down. Like it's the exact same, pretty much like our last 8 deals in the last 2 years, exact same like Freddie Mac, 30% down. Rate is typically a point or more lower than like the current residential rates, because they're just great loans.
Yeah.
Um, 4 years interest only, and then the principal and interest kicks on for the remaining three. But that's what we do for debt. It never changes. We get reached out to a lot by private lending groups and other kind of, I don't know. It's more expensive money, but higher leverage loans, and it's tempting. Like I could see where as like a buyer and a syndicator, like it'd be tempting to only have to put 15 or 20% down, or it'd be tempting to get your first loan and then do a bridge on the backside or get a HELOC or something and pull more cash out and then try to execute the plan on that. But when you actually pencil, apartment deals specifically, there's just so much risk to that like I want to be able to sleep well. So, for me, again, going back to conservative underwriting and forecasting, I know what our debt payments are going to be for the full 5 years, like for sure. Like they're not going to change. Um, and I like knowing that.
Yeah.
Um,
And I will just say from the IRA side, uh, higher leverage means higher UBIT liability. So yeah, that's I think um, the leverage that you're obtaining is can be more attractive for IRA investors.
Yeah, well, that's good to know. And we've had some good success bringing in, IRA investors. We've probably, I don't know, brought a couple $1 million from investors in the last year, utilizing self-directeds. And, I think that is like a very unknown thing.
Yeah,
Quite frankly, I didn't even know that it was possible until like 2 years ago. We had an investor meeting and we were, raising money on a deal, and someone asked, "Hey, like, can I use my Roth or whatever, to like invest in this?" And I was like, I don't think so, like, and Lauren, my business partner, was like, we should probably look into that, like just to be sure. And then like an hour later, she's like, hey, we can,
yeah,
like, so it was kind of one of those like, oh shoot, I didn't know.
yep,
Um, but yeah, so exit wise, the way that I think of exits is either obviously a sale, um, or a cash out refi that, you gets all your equity back, right? So like that's sort of to me like a financial exit, even if you're still holding the deal. Track record wise, we've done about 17 deals in total, and we have exited 8 or 9 of them, in that kind of definition of either sell and 1031 as something else, or we cashed out, still hold, and we're totally made whole on the deals. So our business plan though is not, we're not a quick turn shop. Like we don't make big promises to people that we can't deliver on. Like the whole model for us is we take 3 years to essentially stabilize a building. Like that's what it's going to take to increase rents. We need a couple lease renewals. We need to probably get rid of a handful of tenants that we inherit, when we buy the building. We need to get the expenses cleaned up and understood, and some of the CapEx stuff done to get us there.
sure,
And then we typically look to transact, once we're in between year 3 and 5. And so, I think the longest that this has taken to date is like 4 years, for us to either to go full cycle on something, meaning either a sale or a refi, and be able to get our money back out of it. then again, though, markets were really good, and I don't know. Like, I don't know what the next 5 to 7 years holds. Like, it feels to me like it's a really good time to be buying. So, we're buying. I think overall sentiment is we've reached the bottom, as far as like in our region, values are probably the lowest they're going to be for a while. So we're trying to accumulate as much as we possibly can at these like amazing bases that we can find right now. So we're really actively raising money and looking to do more deals. But I think that the expectation for an LP investor should be 5 years.
Hmm.
You'll get your 6 to 8% cash flow along the way. And then when we sell it, we're looking for like a 1.75x multiple on equity. So, if you put 100 grand in, we'll get you 175 back plus your cash flow. Like it's kind of how we look at it.
With on so you said you do either you have a sale of the property or you do a refinance. In the case of a sale, who does your buyer usually look like? Is it a REIT or someone like that?
It kind of depends. So like when you're down in the, 4 to $7 million like sale price
Hmm.
range, it's super random. It could be wealthy families, it could be business owners, it could be people that want to retire and just want like stabilized cash flow. It could also be other syndicators, like it's very random. When you're between 7 and 15 million, it starts to become more like kind of family offices, sophisticated purchasers. What our buyers why we get the deals that we do, I guess I'll back up even a little bit more, is, they require some work. Like, there might be some galvanized plumbing that we need to swap out. Like there might be some roofs that we need to replace. Like there's definitely going to be some operational stuff inside of the units that we need to do. There's going to be cosmetic rehabs. Like there's work. And so like that's why we're buying the deals at the prices that we're getting them for. But oftentimes the buyers that are buying from us don't want that. Like they're
Yeah,
happy, they're happy that it's all done. They're happy that the deal is clean. They're happy that the cash flow is clean. Our reporting is very clean. So like, trailing financials and all that stuff's very clear. And they just want to know that they're going to get their, 6% cash on cash return with the market appreciation that the greater Puget Sound region and, the Seattle area has always had. And they're going to get the tax shelter, so that's who we're selling to.
and how are you sourcing your deals? That's what I wanted to ask you.
Yeah, I would say the answer to that is 16 years of being in the game here.
Yeah,
Like that's probably the most accurate answer. It is a plethora of people and avenues and routes, and I would say half of the deals that we get are direct from owners that like I've either bought from in the past or met at something, or maybe they're an investor of ours that has something that we want to buy or whatever, right? Like it's literally like just people. And then the other half is brokers, but it's not listings. Like there's I don't think there's been a time that we've bought something that's been listed.
sure.
So it's brokers that are kind of using us as like, I don't want to say bait because that implies like a bad thing, but like they kind of use us as like hey, this group Veritas, they're a real buyer. If you want to sell your building, they're a real buyer. Here's a real price. They'll actually get it done. Like we'll actually execute on it. And so like they're always off market that way.
Yeah.
Um,
So you're not
but
exactly
it's
being used as bait, but you're you're kind of the carrot that's being dangled a little bit. Yeah.
Yeah, that's a better way to put it. Like we're the carrot of the reliable buyer that will actually transact, and like, and we don't. Our reputation in the market is getting stronger and stronger every year, as we don't mess around. So like we'll tell you if we like the deal or not within a week. When somebody sends us financials, we'll tell you what our price is. We don't really like, we're not that big of a negotiation shop. It's like I just like to say, here's our number, kind of best and final right out of the gate. And then obviously in our diligence process, if we find some problems or whatever, like we'll need to retrade it a little bit or get some money off or get some credits or whatever. But we're really simple from that sense.
Cool. Just a reminder, everyone, we're kind of getting toward the end of the conversation, but we haven't received any questions yet. But if you have any questions or any feedback or comments, please use the Q&A feature on Zoom to ask those. Um, I will ask you to take a deep breath, Alex, and talk about cap rates for a moment. I think because what you did is said the thing that has actually really resonates with me because in my shoes, I talk to a lot of sponsors. I look at a lot of pitch decks, and I see cap rates being discussed and presented in a myriad of ways. So
Yeah.
I think I'm probably not the only one. I think some people on the call might be in a similar position. But it's also helpful for people who want to know more about you, how you view cap rates and your perspective towards them. So,
Yeah.
please provide some foundational knowledge for those who don't know, and then talk about your observations of what you see.
Okay, here we go. Um, Cap rates. So I think that I don't think that it's misunderstood across the board. I just think it's misused, and like potentially thought of wrong, as far as, buying deals, evaluating deals, like calculating an entry cap rate and an exit cap rate and all this stuff. So cap rates, the way that I define them and the way that I think about them, and maybe there's a flaw in this, I don't know. I'm always open to learning, but I think the best way to think about cap rates is to understand what a realistic stabilized cap rate is in your market. So if we talk about Seattle today, that's probably like a low five, maybe 5.5% cap rate on a stabilized deal. Like something where like rents are at market, expenses are clean, like something we would be selling,
Hmm.
right? And then you go an hour north, and I think it's probably a 5.5 to six, maybe a 6.5 cap, depending on the city, depending on the vintage of the property, like all these things. Then you head 4 hours east to Eastern Washington, and there's going to be markets out there where the market cap for a stabilized deal is 7.5%, 8%. Like it just depends on the market. Just yesterday, I was talking to a potential investor that invests in other parts of the country, and he was looking at our underwriting, and he was like, "I I could never buy a deal that has an exit cap projected. What was his number? Below a 7.5% exit cap. Like that was just his like answer.
Yeah.
And I have an actual like white paper that I created on this, like a research document on historical cap rates in Washington State, Greater Puget Sound area, and like the highest it's ever been in the West Side major metros is 6.5%, and that's like the worst real estate crisis we have ever had. So like that is like the worst it's ever been. So it's like this is where I think it gets kind of misused as far as market data. You need to be like really specific to like a city, like not just a region or a state or even a county, like it's like the cities are kind of different. Entry cap rate is another thing that I think is interesting. And then you'll see brokers say pro forma cap rate, and like all of these things fluctuate. Really, the way I think about a cap rate is like if you were to buy the thing in cash, what would be your cash on cash return, like after OPEX, operational expenses get taken out, like ballpark, that's like what a cap rate is, right? And so when I see an OM, an offering memorandum that a broker presented and said, the current cap on actuals is 2%,
Yeah.
but the pro forma cap is 9%, and the market cap is 6%, so like you got to pay basically at like a two cap or something like to get the deal, but then you can run it better and increase it over time. Like that's what most new buyers get tricked by, is like the potential that's being sold. And then you're actually paying like as if it was already there a lot of the time, and like that's how they bake in the pricing. So this is where, for us, the way that I think about it is I need the deal to have positive leverage from day one. Like I need the cash on cash rate to be higher than our interest rate on our loan. That's kind of like a simple way to think about it for
Hmm.
me from day one. And then every year though, our like operating cap rate is going to increase, because we're increasing rents, we're decreasing expenses, like we're doing all of the things, right? So like there's all these different perspectives, but the only one that I think matters is to understand your very specific location and like what a realistic exit cap is going to be on the deal. Like that to me is the most important thing. And then current cap is important to understand. But if you know the current and you know the exit, you know the market, it's like, and then you can kind of stress test. Like, so the way that we're looking at deals now, I remember the last deal I sold out of Seattle, it was like 2018 or something like that. And we sold it at a sub three cap. Like it was, it needed maybe a little bit of move in the rents, like the broker could sell kind of a little song and dance, but it literally sold at like a 2.8% cap rate. It was crazy.
Yeah.
Um, Now, that deal's probably like a six cap, like in the market, like that's just probably what it is. So things change. Um, what I like to do now is I say, okay, the market is about as bad as it's been, everywhere, but like in Washington State, like, these are really, really good price points right now to be buying. So that's why we're buyers right now. Um, but I don't think it's going to get much worse. So how we do our underwriting is I say, I think the current market for Edmonds, Washington, which is like 20 minutes south of Seattle, is a 5.5% cap rate on a stabilized asset. Like I think that's pretty defensible with data and like transactions and comps and all these things. So if we can come in and I can buy it at like an existing six, 6.5, something like that, that's a great deal. We're gonna do that. We're gonna increase the rents over time, decrease the operating expenses, and then when I do my stress testing for the exit 5 years down the line, I say at the net operating income of X, that we think we can get this deal to, what's the sale price at a five? What's the sale price at a 5.5? What's the sale price at a six? And what's the sale price at a 6.5? Because I think that's generally the gamut, that like if cap rates compress and interest rates come down, cool, we'll probably sell it at a five cap.
Hmm.
Like I'm not telling anybody we're going to sell it at four. I mean, lots of deals sold at four. There was a comp that just sold there at like a three, but it was on pro forma, right? Like that kind of stuff. So we just stress test it all. And so like if I can see like a 6.5 cap exit in a market that historically is a 5.5 cap, and that deal still would make like a 13, 14, 15% a year return, we're happy.
That's
Like
good. Yeah.
that's a pretty conservative way that we think about it.
Got it. Beautiful. Uh, lesson over. I appreciate it. Thank you very
Yeah,
much.
yeah,
All right. I am gonna say that's gonna be our convo today. I want to share your contact information with everyone through the chat. So I is the best email for you, Alex at veritasequitypartners.com.
that's correct. Yep,
All right.
yep.
So just bear with. Cool. So I just shared that with the group. Let's see. Just a comment from Jim who said, thanks very much for the conversation. So thank you, Jim, for joining. Alex, I really appreciated talking to you today. And this was really, really educational for me and for everyone on the call, especially because the conversation we focus about Washington State, of course, but to take that and put it in the context of talking about other markets and certainly what you just described about cap rates was very, very illuminating. So I appreciate all of your knowledge and everything. To everyone who joined the call today, again, if you have any questions for Alex, you can reach out to him at alex@veritasequitypartners.com. If you have any questions for me or need anything about self-direction, you can always reach out to engage@camaplan.com. And then we will have this recorded and we'll send it out to everyone who joined as well. So thanks very much, Alex. Any parting words?
No, this was great. I appreciate the conversation and the questions, and I love talking about this stuff. So it's
Awesome.
it's my it's my pleasure for sure.
Cool. All right. Well, thanks everyone for joining. We'll see you on the next one. Alex, have a great day. Everyone else have a great day and great week. I'll talk to you later.
Thank you.
Bye-bye.